So the portfolio review videos that I do really just set a benchmark for what is possible. A lot of you guys that are hearing the message earlier on in your life, probably a lot earlier than when I started. I've been self-directed investing for the last 8 years. So for a lot of you guys that are in your 20s and you're hearing this message, pay attention. The message is very, very powerful in that we remove a lot of the guesswork from investing. We provide solutions that get you guys on the right track of picking the right account and putting that account on a track for the long term. And I offer these portfolio review videos to really just provide kind of a benchmark for what's possible, what's been possible for me. A lot of creators will charge for this level of service. I think it's absurd. I don't do that. I don't mind the transparency. I'm actually proud of the product that I've been able to build over the last 20 or so years of investing. And I've added a few pillars that I haven't disclosed in my previous portfolio review videos. So we're going to jump right into it, and hopefully I can walk through the pillars of the brokerage account and the 2 Roth accounts as well, show you guys what my allocation is, and actually show you what the holdings that we're working with right now are at this particular juncture, guys. So without further ado, I'll kick you into the account right now, and we'll kind of walk through the meat and potatoes of the portfolio review. Thank you so much. So this is the asset allocation overview. This is a pretty cool model of how the portfolio is broken down. I always talk about no portfolio is perfect. No portfolio needs to be the same as the next. That's why when you seek out your information on YouTube, it's typically very important just to understand and understand it as a discussion. A lot of people will charge for this information. I do not. I don't see the purpose in that. I don't mind sharing what I've got in the portfolio and what have been some of the strategic moves this year. And some of the moves have been to address, you can see here the large cap value and the large cap growth really takes up a dominant section. And where I don't mind that being the dominant section, these are some of the large blue chip companies in the U.S. And quite frankly, it will probably be that way for the remainder of my life because those are going to be the generational pieces of this portfolio as it passes through and we start to build a legacy for future generations. This is very important, but one of the key additions that I've made to this portfolio is to add more small cap exposure as well as more equities blend in the portfolio. You'll see here some international equity that takes up a pretty good portion. That was showing up on my allocator tool that I needed to add to that. So I just kept the large cap and the value the same and started backfilling with some of the small cap and mid cap that were also coming up fairly shy, and recommending that I add some to that exposure. But you can see here on the top line the large cap growth and the large cap value obviously take up a lion's share of the portfolio, and that's indicative over here of just the equity. Now the equity section of the asset allocation, the equity that includes your sector spider ETFs and your total market ETFs that I've got in the portfolio. Just the small orange section here will represent around 12% of the fixed equities. So even as an aggressive investor, I do have this section over here that I've added this year. I'm very proud of this addition. I've been wanting to do this for a long time. I'm adding more short-term and international to kind of even out these percentages with the intent of lowering the long-term bond exposure and increasing the short-term bond and the intermediate-term bond exposures in the fixed income section. I'm very proud of that. That's kind of cool. Just a starting position here at 23,000 will represent about 12% of the portfolio here. So just kind of gives a really good visual breakdown of what the portfolio holds now. And what we've got here for equity holdings, fixed income, and currently what we have in cash holdings. Some of that is the new contributions for 2019 that I've kind of held up with the market being up here in the last 5 days straight. So we'll look to strategically buy that as the market comes back again. So we're going to move on to the individual holdings section, so stand by. So I typically offer this screen right here to show the percentage of sector allocation that I have across my portfolio. This really helps to give a one-shop stop of where I've got my money kind of spread across the 11 sectors. So you can see that I've got a pretty well-balanced portfolio. I've come out with the percentage of allocation that I tend to shoot for. So as we kind of work down the list here, you can see, what I've gotten where. And this can be, in conjunction with sector spider ETFs as well as single holdings. So if we look at the first one, for example, in healthcare, you guys will know that just over 14,000 is made up of a few single stocks and then the healthcare sector spider ETF. Same thing as we work down with the consumer staples at 6.27%. That 11,000 there that you see represented for consumer staples is a combination of both the sector spider ETFs. That was really one of my big portfolio goals for 2018 and going into 2019 was to add some more diversification and kind of pare back on my single stock exposure. I did that for a number of different reasons. I really just felt like the stock market had really given some indication there over October, November, and December that that we were kind of entering into a potential downturn in the market, or at least a downtrending market. And I was up in some positions, so I took the opportunity to transfer some of that wealth into a little bit more diversified posture. And I'd been wanting to do it for quite some time, but you can see those are reflected in the numbers here. Information technology, I'm right on the money there. That's the exact exposure that I'm looking to get there in information technology. My very favorite sector at 32,000, but I've got multiple stocks. You guys know across that sector. We'll get into that when we get to the single stock holdings. But a combination of both single stock and sector specific ETFs as well. As we work down the list, discretionary is also a combination of sector specific. Again, you guys can kind of see the trend how I'm trying to get good single stock dividend growth out of those staples and discretionary. Not a whole lot of growth in those areas. Technology certainly does have the majority of the growth, as well as the communication services sector. Discretionary, of course, that gets taken up by now Amazon, which used to be technology, but has moved to discretionary now. So that helps increase that percentage of exposure within discretionary. Industrials as well. I'm really enjoying the diversified performance of the sector spider ETFs as well. I've been paid now a dividend on most of them. You guys know that I have my stocks set up for dividend reinvestment in this portfolio. So definitely day in and day out, the portfolio is working for me. And if we comprise a portfolio in this manner, it's doing its job. If you've got it set for dividend reinvestment and those dividends that are being paid, randomly throughout the year, quarter per quarter, are rolling back into the purchasing more shares for you. And that's really one of the secrets of portfolio and wealth building is to make sure that you've got that ability for your money to work for yourself within the portfolio. Very, very important. So industrials, a very important sector. Materials, not so much my favorite. I've got materials and utilities as being kind of the sectors that I don't get too crazy on, as I've just got a little over a 1.5% exposure there. I think most of that exposure comes through my holding in DowDuPont, and I don't own a sector-specific ETF. I don't care to do that. I'll gain my exposure there based on my single holding at just around $3,000. Financials, a very important sector. I own multiple single stocks as well as the financial sector specific ETF. Communication services, obviously overweight there, probably due to my holdings in both Facebook and Google, and just my core holdings as well on my telecom, my legacy telecom holdings in Verizon, China Mobile. Really a good basket of stocks there, very heavily weighted to growth, having again Google and Facebook in there, but certainly looking at that as a revenue or a vehicle for growth. And if that does start to produce some profits there, I'll be looking to reduce that sector exposure, because you guys can see they're at 21%. I'm a little bit overweight and working down utilities. I've already discussed that. I did sell my position in Dominion Energy, so I only hold the utilities sector spider ETF there for my utilities exposure. Energy, I'm kind of right on the mark. I own a lot of single stock there. No spider ETF there in energy. Real estate, I've got my one holding in American Tower REIT. That's where most of that exposure comes from. And then finally the equities blend, where that is taken up by the small cap VB small cap ETF from Vanguard, as well as the emerging markets. So that'll be a mix between those two, to where they of course don't fit into a specific sector. They're a lot more overarching on the small cap side. Market capitalization of stocks over $1 billion in the small cap ETF. And then finally my representative from the emerging markets ETF, which I've also added this year as well. So I'm going to kick you down to the individual holdings and have a little bit of fun, show you guys what we're working with in the portfolio. So stand by just a second. So when we do a portfolio review, this is really the nuts and bolts of the portfolio. These are the parts that construct the portfolio, and these are the products that I seek out to give me the exposure that I desire. So as I kind of work down these, you guys will know how I run these portfolio reviews, complete transparency. So pretty cool for you guys to see, what's going on behind the scenes, with all the partial shares. This is really a good sign of an established portfolio. If you don't see this here, then you're probably chasing after way too much growth in the portfolio. So these partial shares here, this is a result of your dividend reinvestment program, and it's just an indication. I've probably got AT&T. This was probably an initial block of 100 shares, and it's paid me dividends enough to give me almost 5 shares for free of the stock. So that's really the power of compounding interest, but more specifically how the dividend reinvestment program contributes to the compounded growth over time. It really just starts to accelerate on its own. One of the very, very unsung heroes of why we invest in the stock market. But you guys can read this for yourself. Certainly, I'm not going to go down the entire list. The ratings, I look at these, but it's just interesting to see what the size of the position I've taken. Honestly, some of these growth stocks were aimed at getting specific exposure to certain industries, Adobe and the cloud being one of them, just at over 1% of the portfolio, so you can kind of see here, there's no one stock, a 10-share stab at Alibaba here at less than 1% of the portfolio. So we're really winning here, spreading our diversity across. Google, a long-term holding at over 5%. I mean, those are over $1,000 a share, almost $1,100 a share here. 10 shares of Google, just one of probably the top pick of 2019, to be honest with you. And you guys that are invested in M1, I've brought up both Google and Amazon as being potential candidates for a partial share acquirement, because you can buy partial shares, and maybe after a few months of partial share purchases, you can actually obtain a few shares of these great companies. Amazon here at 4% of the portfolio, AIG was a new addition here. I wanted exposure to the insurers, and AIG was that one that I determined fit the bill here at just under 2%. American Tower REIT, of course, just been one of my favorite. Listed as a financial, but it's also, it's a tower, it's a REIT that's falls under the financial services category. Really one of my favorite stocks. Just had a blowout quarter last time, got drugged down with the rest of the stock market, but there's going to be very good things long term for American Tower REIT. Trades at a fairly rich valuation, but you're paying for the quality there. Apple here with the partial shares at 4% in the portfolio, and so on. I don't need to go over all of these. AT&T, Baidu, another one of those companies that just was on a valuation perspective. A lot of these had PEG ratios of well below 1. I know Alibaba did for sure. I'd have to recheck what the PEG was on Baidu, where we just take the price to earnings and divide it by the future growth. A very, very good indicator of whether a stock is ready for a buy or not. And these Chinese stocks were really ripe for the pickings, so picked up 10 shares here at Baidu. Less than a percentage of portfolio exposure there. Chevron, China Mobile's almost back even again. One of my fallen angels for 2018, and I'll be looking to do a follow-up once my fallen angels all turn back into the black for me. Took those into a pretty significant downturn, but we're almost back to even again on China Mobile. Made dividend reinvestments here the whole time here, guys. So this is huge. So the 2.0811, I would probably say are free shares of the stock, so benefiting from that appreciation. Citigroup, Disney, Dow DuPont, that's my one materials holder. ExxonMobil, I'm long. It's just hasn't been a very good performer this year, but I hold that for not only the dividend reinvestment program there, but also the potential for appreciation growth. And that's how I seek my energy exposure there through Exxon. Here, Facebook as well, 90 shares in Facebook, around 6% of the portfolio. Very appropriate for a long-term investor at this juncture in the game, having social media exposure. One of the premier companies in social media. General Electric on its way up at just over 1%, even with all the additions to the portfolio here. Intel, IBM, some of the tried and true big tech companies here at 2.5% and 3%. JD.com as well, round out the Chinese holdings for my international exposure. I'd almost rather just pick and choose the companies that I want here. Johnson & Johnson, JP Morgan, Kraft Heinz, I've made that addition there. This year I've shared that addition with you guys at 117 shares, so boost that up over 2.5%. Marathon Petroleum, probably my most exciting energy company that I took a position in this year. So I hold a very good angle on LNG. That's what I wanted for long-term future growth. And not only Marathon Petro, but Royal Dutch Shell for my international exposure as well. And then Medtronic, one of my favorite growth in the healthcare. It's the only growth in the surgical medical device arena with Medtronic. And then finally Microsoft, again, just duplicating my cloud exposure there with Microsoft. I do see Microsoft continuing on its upswing at just over 1% in the portfolio, and I'll get to the next page and we can round out this portfolio review, guys. So this will round out the portfolio review. I really enjoy offering these videos. This really just shows what's possible, in the investing world, and focus in on some of these really cool aspects that don't get talked about enough. I mean, everybody throws out dividend reinvestment, but to actually see it come to results in the portfolio, you can see here these partial shares, and if you're not enjoying these partial shares, it's indicative that you're not taking advantage of the dividend reinvestment program in your Roth IRAs, man. Every time that dividend is paid, it's paid tax-free to you to grow into the future, and it really helps accelerate that compounding growth. So very, very important Just to start out here, Mondelez, we're working here across 0.5%. I reduced that position down to about 20 shares. May look to add back to it. That's fine, but took some profits in the shares. Morgan Stanley's a new position this year in the oversold financial sector. 80 shares there at about 1.5%. Northrop Grumman is my representative from the defense subsector of industrials. So just I've got a lot of favorites in this sector, Lockheed Martin being one of them, Raytheon being the other one, and just one of my favorites here. Doesn't pay a great dividend, but it's starting to accumulate there, and hopefully we can get some stock appreciation out of Northrop this year. PepsiCo took some profits here, reduced it down to a smaller position, looking to add back into Pepsi again. I sold some of these stocks at a really good time when I had profits in them, and then the volatility kicked in and I was able to ride these smaller share amounts down. And then Pfizer, the same idea. Pfizer, I did very well with that as well, sold at 46. It went down to 41. Looking to take a new position and add back into it. Basically just channeling the stock, guys. It's not rocket science. When you have the opportunity, the option there to take it is there, and if not, no big deal. But you try to win as more than you have winning. I mean, you can sell a stock and it can continue up. That's fine. It happens. Right Smile. This is a joke in the portfolio. I got asked on this last time. But this is the 1 penny stock I have in the portfolio, just kind of an eyesore in what is a very quality portfolio. But just continue to work down here. Royal Dutch Shell. You guys know I hold this for international oil exposure, and not only that, the LNG. This is the #1 producer of LNG in the world. Salesforce, probably the highest valuation stock in the portfolio. High growth tech in the cloud computing space, consumer relations management, very, very important. I don't care. Basically, I wanted to invest in a company, around 2% here of exposure. Starbucks, great company. Hold this now in the joint account, in the taxable account outside the Roth. Looking to build a position in Starbucks. UTX was really one of my best opportunistic buys. I picked that up close to $100 a share. Just couldn't help it. It had come back too much. UTX, one of the finest the top industrial holding that I have, actually. A lot of favorites in this sector as well, guys. A lot of value to be had. FedEx comes to mind here. Some of the larger Caterpillar. I really like Daimler Chrysler as well. On a valuation standpoint, PEG ratio there is just really, really worth looking at. But UTX is my holding. And as we work down here, we've got our sector spider ETFs and some of our total market ETFs as well. Consumer staples, emerging markets, healthcare. I've got a sizable position in this spider ETF. I just thought it was a better way to own the healthcare sector or own the healthcare sector from a diversified perspective. And this is really one of the biggest takeaways of this video, is you can see how I've built up these diversified positions. The industrial ETF here as well, information tech. I've got my bonds portfolio. I'll give you guys the ticker symbols there. That can really help you if you guys want to research those on your own or throw them into a fixed equities watch list. You could do that as well. But again, just to see these little money machines here working, each and every one of these investment products are working. I've got pretty sizable positions in each of these fixed equities positions, and I'll be doing a follow-on video that talks about just the fixed equities. I really think it's very important. I mean, you guys know I only have 12% right now, but we'll look to increase that over the course of my life, and that's great. That was a new addition to the portfolio. Before 2018, I did not have that, and what a great year to add some fixed exposure to kind of counterbalance some of the volatility. And then we work down here the small cap, my favorite small cap ETF here in VB, the Vanguard's close to 5,000 there, and the total market exposure here. This is BND. This is the last bond fixed equities that I've got. That covers the entire market, and you can see all of those have paid partial shares. I've owned those for a few months. And the utilities ETF, that seeks my entire exposure to the utility sector, so pretty cool there as well. Just over $3 grand 1.5 in the portfolio, so kind of cool. Verizon, Visa, and technology. I've owned Visa in the past, owned a lot, made a lot of money with Visa, and just repositioned that back into the portfolio. Just best in breed as far as the payment space, just at 1% or so there. Wells Fargo almost liquidated down in Wells. Not sure if I want to add to the position here, as I've got other financial names that I'm happy with. 3M in the industrial sector here, just a buy and own forever. Dividend aristocrat, obviously. And just one of those stocks that you can put into the portfolio as a cornerstone, just over 2% there. And then finally, Blackstone Group, which I'm going to be looking to phase out of the Roth IRA. There's been some discussion in the group about owning limited partnerships within the Roth IRA. There's a limit of profit that you can make without subjecting yourself to tax sharing within the limited partnership, even if it is held in a Roth IRA. So up to $1,000 of profit is okay, but we're going to try to get this back into the black and then start to absolve this position of Blackstone Group in the Roth, and we'll shift those profits up into some of these other quality single stock or sector spider ETFs or both. So guys, that rounds out the portfolio review. Really hope you enjoyed. I'm going to kick you back over to YouTube now. Thank you. So we've come back out of the portfolio review, guys. Thank you so much. I really appreciate this. There's no perfect portfolio out there, all right? You're not going to build a portfolio like this overnight. It takes time. And for you guys that are willing to build a program as a self-directed investor, and you guys are out there and you're in your early 20s, early 30s, and you haven't thought about investing, certainly consider looking at the self-directed option. It really just puts you in the driver's seat to your own portfolio. It really allows your money to be liberated over time. No fees, no tax, it gives you the tax protection within there. And this is just an example of what's possible as a self-directed investor, guys. So if it's your first time tuning into the message, man, I highly encourage you to consider subscribing to the message. Hit the thumbs up button if you enjoyed this video, this review of my portfolio. Certainly leave your comments at the bottom if you think I've got gaps or overlaps in the portfolio. If you enjoyed the message and appreciated my transparency, I'd appreciate that as well, guys. Thank you so much for tuning into this video, and good luck in your investment future.